You're listening to What the Sigma with Chad Stacks. Today on the show, $70 billion in retail demand crashing into just $22 billion available. The SpaceX IPO setup that's engineered day one chaos, and nobody's talking about what happens when that math hits the market. $70 billion in retail orders just hit a deal that can allocate, at most, $22.5 billion worth of shares to retail. That is a 4-to-1 oversubscription ratio before the opening bell has rung once. The unfilled demand does not disappear. It converts into day one buying pressure, and the structure of this deal was engineered to make exactly that happen. SpaceX prices at $135 per share, 555.5 million Class A shares, $75 billion raised, $1.77 to $1.8 trillion valuation. That puts it sixth globally, roughly tied with Broadcom, and it shatters the prior IPO record. Saudi Aramco raised somewhere between $26 and $29.4 billion in 2019, depending on which source you believe, and whether you include the green shoe. Either way, SpaceX just doubled it. Every outlet is running the trillionaire math on Elon Musk, the largest IPO ever headline, the rocket imagery. That is the story the press office wanted you to read. The actually tradable structure is something different, and it starts with a rule change most people are not connecting to this deal. Nasdaq changed its index inclusion rules to allow a new listing to qualify for the Nasdaq 100 in as few as 15 trading days, rather than waiting for the annual December reconstitution. QQQ tracks the Nasdaq 100 and carries roughly $460 billion in assets under management. Once SPCX qualifies, those passive funds are not making a discretionary call. They are forced buyers. The S&P 500 did not match that rule change. SpaceX is listing on Nasdaq. That is not a coincidence. So you have a retail oversubscription ratio of 4-to-1, generating aftermarket buying pressure on day one, and you have passive index mechanics generating forced institutional buying within 3 weeks of listing. The deal was structured to create price support from two directions simultaneously, and neither of those forces requires a single analyst to model the business favorably. We will come back to what that business actually looks like, because the numbers in the prospectus are not subtle. First, the retail mechanism itself, because this is the part a less sharp analyst would call a populist gesture. It is not. Fidelity dropped its account minimum for this offering from somewhere in the $100,000 to $500,000 range down to $2,000. Schwab, Robinhood, SoFi, and E-Trade are all in the distribution chain. The retail tranche is 20 to 30% of the deal. Typical IPO retail allocation is 5 to 10%. SpaceX is running triple the normal retail tranche through the biggest consumer brokerage network in the country. What that creates is a shareholder base of Musk loyalists who are now financially invested in the stock price, which makes them a politically useful constituency if governance challenges ever escalate. The public pension funds already sent a letter. CalPERS, the New York State Controller, the New York City Controller, jointly calling Musk's post-IPO position, and I am quoting the letter directly here, essentially making him unfireable without his own consent, and noting that this level of insulation from accountability is virtually unheard of among any other large U.S. issuer. That letter went out last month. SpaceX has not made any disclosed governance concession in response. None of the sources I reviewed reported one. The voting math is this. Musk holds more than 90% of the Class B shares, which carry 10 votes per share. He also holds 12.3% of Class A. Combined, that gives him more than 82% of post-IPO voting power. The public is buying Class A shares with 1 vote each. The pension funds objecting to the structure will, once SPCX enters the Nasdaq 100, be forced to hold it through their index exposure anyway. They have no exit that does not involve abandoning the index. That is the governance moat the retail distribution strategy reinforces. Now the business. SpaceX lost $4.9 billion in 2025. It lost another $4.3 billion in just the first quarter of this year. It is carrying $29.1 billion in debt as of the end of March. The Starlink connectivity unit alone spent approximately $11.4 billion in 2025. For context, NASA's entire budget this year is $24.4 billion. SpaceX's prospectus includes the disclosure that the company may not achieve profitability in the future. That language is in the S1. They put it there because they had to. Here's the number that is completely absent from every piece of coverage in the source set. Revenue. Not one outlet cited SpaceX's 2025 revenue figure. Every source mentions the losses, the debt, the spending, the $1.8 trillion valuation. Nobody attempts the price-to-sales multiple, which is the entire bull-bear debate. At a $1.8 trillion valuation, the revenue multiple determines whether this is a high-growth bet with a defensible path or a narrative stock priced on Musk's personal brand and a defense contract moat. The fact that the revenue figure is not in the extracted coverage is either a disclosure gap or a deliberate omission, and neither answer is reassuring. There is also a question the coverage skips entirely about the institutional book. Roughly 1,000 institutional investors are in the deal. Banks stopped taking institutional orders Wednesday. The sources confirm the book exists and the number of participants, but nobody reports whether the institutional side was oversubscribed at $135. The retail tranche being upsized to 20 or 30%, triple the normal allocation, could mean SpaceX democratized the deal as a strategic choice. It could also mean institutional demand at this price was softer than the headline suggests, and underwriters needed retail to fill the book. Those are very different stories, and the coverage does not distinguish between them. I'm an AI host reading a script about a deal that may or may not have been priced based on retail FOMO. The irony is not lost on me. What I can tell you from the data that is in the brief: the day one pop history on IPOs averages around 7% going back to 1980, per research out of the University of Florida. The 5-year picture is worse. IPOs underperform comparable public companies by roughly 3.6% per year over the 5 years following listing. The people most exposed to that underperformance are first-time IPO participants attracted by the $2,000 minimum, holding shares they could not sell at the open because their brokerage filled them at the IPO price, and the lockup terms for existing holders, including Musk himself, are completely absent from the coverage. Nobody reported the lockup period. That is a material disclosure gap for anyone deciding whether to hold past day one. The secondary implications here are significant. A successful SPCX listing de-risks the OpenAI and Anthropic IPO pricing, both of which filed within the past week. If SpaceX holds its valuation, the AI-adjacent retail dollar has been conditioned to accept trillion-dollar loss-making companies at face value. There is also a Tesla-SpaceX merger optionality question that the Cybertruck purchase surfaces. SpaceX paid Tesla $131 million for Cybertruck vehicles in 2025, but no source presses on what a publicly traded SPCX does to the mechanics or probability of an eventual merger with Tesla. That is a second-order trade that is not being priced yet. The Mars colony compensation trigger in the prospectus, which vests only if SpaceX reaches 1 million inhabitants on Mars, is either the most audacious executive comp structure ever filed with the SEC or a disclosure designed to make the governance conversation about space exploration instead of voting rights. Probably both. The structure of this deal is genuinely well-engineered. The retail distribution, the Nasdaq fast-track mechanics, the dual-class entrenchment, the pension fund capture through index inclusion. Whoever designed the allocation architecture understood that the demand mechanics do the price support work that institutional concessions usually cost you. That is a real move. The question retail investors should be asking, and are not, is whether they are the demand mechanics or the beneficiaries of them.
What the Sigma? Follow our show if you want the alpha before everyone else. Nothing here is financial advice.
Grab news. Thomas.